All right. Welcome, everyone. This is John Melanson from Built, our Blacks United and Leading Technology organization. And, we have a fantastic event planned for this evening. As you may already know, we are here for you. So if you look at our logo, we have a little I, big U by design. So let's focus on the individual, more focus on you meeting your needs in the spirit of entrepreneurship, investing and being aware of various opportunities. Opportunity zones have been something that have come up in the conversations as of late. And we really wanted to, have an opportunity to present some information to you to help you better understand, what those are, how it's working. So we brought some of our friends along, and I'll go ahead and have them introduce themselves, starting with you, Chris.
Yeah, thanks, John. I think the story here is really interesting too, so I'll tell that briefly. But so my name is Chris Cooley. I'm one of the co-founders of Ozworks Group, which is a private online community dedicated to democratizing access to resources for Opportunity Zone stakeholders all over the country. So I'll let Carlton and Patrick introduce the incentive in much more detail. But the story of how we got here is kind of interesting. Actually, John, I was connected to you through one of our members who I asked to kind of do some outreach because of a diversity, equity, and inclusion scholarship initiative that we created. So one of the things that we wanted to kind of put out into the world was an accessible product, right? We look at ourselves as sort of the intermediate stage of Opportunity Zone. So you can do a lot of free Google searching and read a bunch of articles. And what do you do after that, right? So there's kind of two ends of the spectrum. And this is a fairly new incentive still. It's going on like 3 years old. But on the one end, there's advanced knowledge and insight and access, and that goes to a lot of privileged, capital type of companies and investors, and they have teams that can do these things. And then you have the sort of other end of the spectrum, which is there's lots of podcasts. One of my business partners, Jimmy Atkinson, runs the Opportunity Zones podcast, and so that's a lot of that beginner material. But when I did a little outreach to our community, which is now going over 200, and I think we have 215 members now. It's a paid network, but we said, hey, from the early stage, we really want to be inclusive as much as possible. So these two gentlemen here are two members of a DE&I committee that we formed within the first 2 months of launching Ozworks Group, and they've been around. We launched in January of this year. And so we're still fairly young, but there's definitely a need in this marketplace, in this industry for this community. So we really focus on leading with a giving hand, right? All OZ stakeholders are welcome. All sorts of people are welcome from all different sorts of knowledge levels, right? And this is an incredible event. So long story short, I got connected to John through one of our members. John mentioned, obviously the mission of Built, and we just really aligned with that. So when I talked to Patrick and Carlton about presenting and making this knowledge more available, they jumped at it, and we also have a new round of scholarships available, which is 6 months of paid access to Ozworks Group, which is also including access to different types of capital. We have a track that we're developing. And also just connectivity to people like these two guys who are incredibly knowledgeable. So I thank you for having us. I thank these guys for joining and making their time available for this type of education. And I will pass the mic to my man Patrick, and then Patrick can pass to Carlton, and we can dive into some of the details. But thank you for having us, John. I know it's kind of a roundabout way of me saying that, how we got here, but here we are.
Thanks, Chris, and thanks, John, and thanks to your community for having us. My name is Patrick Shagru. I live in and I hail from, at this point in time anyway, Grand Rapids, Michigan, although I did grow up in San Mateo, California during the wonder years. I have practiced law for longer than I will care to admit. And I've always concentrated on business finance, business structuring, business transactions, a lot of quirky tax advantage type stuff. And so when the Opportunity Zone legislation came about, I was like a proverbial kid in a candy store. It dealt with growing in early stage businesses and economic development, which I love. It had a lot of quirky tax provisions, which I like. And I was blessed to find Chris's group, which had just started, and become a member, early adopter, and meet really who I consider my brethren and fellow OZ cohorts, including Carlton, and have really enjoyed sort of growing in the community and learning. We learn every day from each other, and we're pleased to share what knowledge we have at this point in time with your group. And so we're looking forward to it. Thanks for having us. Carlton?
Good evening to all. My name is Carlton Jones. I'm a commercial real estate broker with a firm called H&H Brokerage in Ferguson, Missouri. I've been in the real estate business almost 35 years. Started in Oakland, California, moved back to St. Louis and did residential for a while, and actually turned to commercial broker right around 2002. I was known as what you call a site selection specialist, managed strip centers and things of that nature, and I've worked with developers throughout my commercial career. As Chris and Patrick have alluded to, I'm part of the DEI committee of the OzWork Groups, the OzPros website platform, which is a platform that provides a variety of resources and information and partnerships and networking opportunities. It's a subscription service that I'm very proud of as far as being able to network and increase my net worth, hopefully, as we go along. So I enjoy what we're doing. And as Chris talked about earlier, Patrick and I, and Chris, of course, we did the same presentation for the St. Louis chapter of the NARAB. And NARAB is the National Association of Real Estate Brokers, which is a African-American brokerage organization started in 1947 that is hopefully and continually doing what you're doing as well in your community, your tech community. You're trying to increase inclusion and diversity and equity. And that's what we're doing with OzWork Groups as well. I love being a part of it. It's a wonderful opportunity to serve the community and add value, especially when we talk about the scholarship program, because it's what we're talking about in a lot of ways in commercial development. It's not taught. You can't learn it in school. It has to come from a vision. It has to come from what you want to see for the future in your community, kind of like drop your bucket where you are. So the Opportunity Zone is a wonderful way to take advantage of that. And what we're going to be talking about today, of course, is this Opportunity Zone 101, which is basically some basic information to pique your curiosity, make you get about more, and know that you can have impact by using some legislation that's designed specifically for community and economic development. So we'll get started whenever the PowerPoint comes up.
You guys see that all right? I'm gonna share, I'll drive here. You good with that, Carlton? Can you see it?
Yeah. Okay, it's opportunity. Oh, the disclaimer. Chris, won't you read the disclless?
Hey, look, I say this, I should let Patrick, the lawyer, read the disclaimer, but you know, because he can do it more officially than I can.
It essentially says the same thing as every other pitch deck disclaimer. So let's move on. We're not providing specific legal or tax or business advice. We're just here to share.
So what are opportunity zones? Question mark. And we call it a Marshall Plan for U.S. cities. An opportunity zone is an economic distress community where new investments in real estate, businesses, job training, and workforce development programs under certain conditions may be eligible for preferential tax treatment. Opportunity zones were added to the Internal Revenue Tax Code by the Tax Cuts and Jobs Act on December the 22nd, 2017. Now, in order to be an OZ, an area, a census tract, and they're all census tracts, must be nominated and designated by state government officials and certified by the IRS. There are now OZs in all 50 states, the District of Columbia, and the 5 U.S. territories like the U.S. Virgin Islands, Guam, Puerto Rico, which is the entire island is an opportunity zone. Now, as the program currently stands, no new opportunity zones can be created. That's important. That's important. There have been so many programs that are designed to help certain communities that as it goes along, it does not help those communities. It go elsewhere. So as I mentioned, there's no new opportunity zones can be created. So it's important to pay attention so that if any day comes about where you find out that there's new borders being driven, then the program might not be designed and going the way it's supposed to go, like a lot of tax increment financing and other programs that have been used by developers or unscrupulous folks down the road. Now, right now, there are 8,647 opportunity zones throughout the country. Now, to find an OZ, you just go to what they call OZ resources, which is IRS notices 2018-48, or you can just go to the U.S. Bureau geocoder, enter an address, and it'll tell you whether or not that address is in an opportunity zone.
Carlton, if I could, there's also a map at opportunitydb.com. And there's a map link right there. So you can actually type in an address and see what pops up if you're in a zone. So that's
correct. There's a variety of ways, but it's very easy to find out if your address or if your property or if your community is in an opportunity zone.
Yep.
Now, the purpose of opportunity zones. The mission and purpose of opportunity zones is to be an economic and community development access to capital. I want to emphasize an access to capital tool to spur community development and job creation in distressed communities. And I'll connect that to my Marshall Plan analogy, a metaphor, an example as I go along. Now, this purpose will be achieved by offering investors the ability to invest capital gains proceeds from any type of investment and defer, reduce, and or eliminate paying taxes on those gains, thereby increasing the rate of return to qualified investors. So how do OZs create access to capital? How do you get your hands on the money? It's all about the money sometimes. And investors, large and small, are always looking for ways to reduce tax liability and find additional avenues for capital appreciation. OZs go buffer though. They do both of those things. You can reduce your tax liability and you have the opportunity for capital appreciation as well. I mean, it's a well-known fact. Rich people do not like to pay taxes. They do not like to pay tax. They'd rather go to space and play Buck Rogers before they pay some taxes. And you do this and you're able to reduce your tax liability and go after the opportunity for capital appreciation by tax referral. Number one, investors can elect to defer capital gains by investing those gains in a qualified OZ fund by 12/31/2026. That is the capital window. We have until then to get capital in these qualified funds and take advantage of the variety of benefits. For example, the step-up benefits, where basically if you keep the investment for 5 years, there's a 10% reduction in your capital gains, or you can keep it for 7 years and there's a 15% deduction in your capital gain. Or if you want to go for the grand slam, there's no capital gain tax on appreciation if the investment is held for 10 years or more. For example, you invest $500,000 capital gains, and in the 10 years or more, the investment is worth, say, 2.5 million. When you sell, the 2 million increase is basically tax-free. Now, the caveat, of course, is to be able to check with your accountant and tax advisor for your particular situation. But in many ways, shapes, or fashion, OZs are an ideal way to accumulate capital for community and economic development. Who can invest? Opportunity zone investments in qualified zones can be made by the following: individual investors, accredited and non-accredited, both C and S corporations, partnerships and LLCs, trusts, estates, family offices, 1031 real estate tax exchanges. Basically, everybody can invest in an OZ fund if you have capital gains. And to qualify for favorable tax treatment from an actual or deemed sale or exchange, it has to be an actual sale or exchange. It cannot be a phony. It cannot be you think it up and think you're gonna get away with something. It has to be an actual transaction or exchange of property, business, stock, bond, or other gain. And if they are included in your calculation of capital gains for federal income tax purposes, on your tax return, those capital gains can be deferred, reduced, or in some cases, eliminated. Now, the gain must be invested within 180 days of the sale transaction. So you have 6 months from whatever day the transaction takes place that created the capital gains to put it in a qualified opportunity zone investment. Now, there are different types of OZ funds. Number one, you have what they call a QOZ, which is a qualified opportunity zone fund for real estate investment and development. You also have what they call a QOZB, which is a qualified opportunity zone for investments in community businesses, entrepreneur endeavors, job training, and workforce development. Now, these investments in the business, they cannot be debt investments. They must be equity investments. And when someone or some group or some fund provides equity investments to your community business or get involved in your job training and workforce development program, it also brings resources, talents, network. It's a wonderful opportunity. And there's definitely a role to be played by community groups and organizations, especially in the job training and workforce development arena. And then the third type of fund is the QOZBF, which is Qualified Opportunity Zone Business Property. Now, as I mentioned earlier, at the beginning of this, I talked about Opportunity Zone Fund being a new Marshall Plan. And I'm going to share why I think that can be or should be at least considered. So what was the Marshall Plan? All us old heads, we kind of know what it is, but for some of the young people, the Marshall Plan was an initiative named after former U.S. Army Chief of Staff and U.S. Secretary of State George Marshall. The plan was passed by Congress as the Economic Cooperation Act on April 3rd, 1948. Now check this out. The act and the goals of the plans were to rebuild the shattered economies of 17 European countries by World War II, restore them to their pre-war prosperity, feed the people, modernize industry, improve European quality of life, remove trade barriers, which creates economic velocity. And of course, prevent the spread of communism, because the 17 European countries included everywhere. Of course, it did not include Russia. Russia didn't want to be a part of it. So that was what the Marshall Plan is. And what I need, Scott, Chris, I need to go on to the last slide, because these slides, okay, got changed, okay. So what happened with the Marshall Plan? From 1948 to 1952, the United States invested $13 billion, equivalent to $135 billion today, for the plan that accomplished the goal of putting the 17 European countries back on the road that is responsible for the modern Europe that we know today. In 4 years, we rebuilt cities, rural areas. Why and how? Because we targeted an investment. In addition to the firm economic foundation created, the following institutions came out of the organizations came out of the Marshall Plan: the United Nations, the International Monetary Fund, the World Bank, and of course the European Union. I say, and I believe, and I know that Opportunity Zone can create a new time for a Marshall Plan for U.S. cities, or a way to achieve the objective by massive, targeted, and impactful investments while the OZ legislation is in full effect. Money moves mountains, and access to capital, once again, our ability to accumulate capital in a tax advantage and a capital appreciation way, will make all the difference for substantial progress for our urban areas. Now, organizations like we have here, of course, your group, community organizations and nonprofits, they have a role to play in OZ investment activities. As Chris mentioned earlier, you can become a social impact partner. You can help track, direct, and pinpoint possible OZ investments in your area. You can provide ways and methods to measure OZ investment impact. There's a lot of ways you can measure investment impact, ways that will attract additional capital. I used to be on the board of directors of an organization called the Metropolitan Training Alliance in St. Louis, and our director and founder, God rest his soul, his way of measuring community impact was to say, if we help 10 people get a job and they all make $40,000, just how much money we have community impacted in the community. You can do that. You can help identify qualified businesses for potential investment. Of course, work with job training and workforce development, community engagement, and contact OZ funds with urban planning ideas and suggestions. And always continually engage elected officials and community leaders about the possibilities. So what we're saying and what I'm sharing today, this basic information, is that this is a wonderful chance to work on our future. And that's what we're talking about. We're working on our future here. And by being a part of the Osworth Group, OzPros, or getting involved with Opportunity Zone funds throughout your community is a wonderful way to have impact on the future and how our community is going to look, not 2 years from now, 3 years from now, but 5, 10, 15, 20 years from now. So I always like to share this information. I'm pretty sure we have some questions and things at the end. I'll be here to discuss and add value however I can. But Patrick will share information, more of the nuts and bolts, and guide it toward some of the businesses and organizations you work with as well. And like I said, we always enjoy doing this, and I hope some of the basic information that we provided will spike your curiosity and make you want to investigate more. Patrick.
Thanks, Carlton. Yeah, Carlton's right. My role is to kind of get a little bit more into the weeds. And in the OZ space, believe me, there are plenty of weeds. And for those who haven't had really much exposure to opportunity zone legislation and the regs and projects, it for me, and I'm a tax lawyer. It took me a long time to sort of figure out who's on first and what's on second. But Carlton, I really appreciate the way you have woven the mission and the concept of what we're trying to accomplish, the mission of opportunity zones, into a demonstrable analogy of the Marshall Plan. Because I think if we lose sight of the mission and we get tied up in the weeds and the technicalities, we forget why we're here. So thank you, Carlton, for that overview. And I'm going to try to now get a little bit into the weeds about how we accomplish the mission that Carlton's challenged our nation to, which is a domestic Marshall Plan. But I'm going to point out a couple of things. Chris, I'm going to tell you what slides to go to. This is a good one to start. Some of them are somewhat duplicative of Carlton, so I'll just kind of go to where I want to go from here. Okay, so it's important to keep in mind, kind of there is some rationale to how they set up this entire tax scheme and regulatory scheme. If you look at this map, the challenge here is that they realize that there are economically distressed communities all over the country. And rather than selecting 1, 2, or 3, or those that happen to be politically connected, they just said, let's do them all and let's let the states pick which ones. 25% of the eligible economically distressed census tracts can be selected by the states through their governors or legislators. So the problem was big, and the folks that got together to sort of write the policy papers on opportunity zones recognized that. That was the challenge. Chris, could you go to 16? So again, some of this it was set up by Carlton magnificently in his analogy to the Marshall Plan. But this is, again, sort of the policy mission of what they're trying to accomplish with this complex tax regime to try to develop our communities. This is an investor incentive. It is not a tax break per se or a handout. It's an investor incentive to drive capital. Incentives are based on the reinvestment of an investor's capital gains from another source. They are geared necessarily toward new or improved projects and businesses and must be long-term holds in order to qualify for the incentives. The incentives are market-based, meaning that ultimately the investors and the communities that choose to partake of this tax incentives will determine how large this program is. There is no dollar limit. There is no number of projects that can be funded in this program. It is up to us, all of the communities that qualify as opportunity zones that have been designated, as Carlton explained, but beyond that, to the investors who may not have a nexus to the opportunity zone, to be able to drive their capital into these communities with no limit. So education about the fact that this program exists and how it can impact us, whether we're investors, impacting communities, or we're communities seeking to be impacted by this investment, it's incumbent upon us to understand that it exists and how it works. And that's why we're here. And really important to keep in mind that the opportunity zone incentive is not a be all and end all. It's not going to solve all problems of all communities. It's intended to be layered and integrated with existing federal, state, and local programs, tax incentives, local incentives, NGO incentives, community-driven incentives, to create a multi-layered approach to revitalizing economically and otherwise communities. Next slide, Chris. So here are some of the specs that the opportunity zones must have and how they got selected. Chris, are we going to be able to make available the slide deck to John and his group?
Yeah, absolutely.
Okay, so some of this we're not going to cover in much detail at all because it'll be available in the slide deck. Next slide, please. And again, Carlton went over very well the stakeholders and those that tend to benefit from this whole OZ space. I've sort of broken it down into sort of functionally businesses, investors, community property owners, community development organizations, governmental units, financial advisors. There's a lot of folks in terms of the discipline or their practices or their jobs that are stakeholders or potential stakeholders in this program. Next slide, Chris. So this slide is actually a little bit dated. We haven't upgraded it from 2019, which is the first 2 years of practice of the OZ program. But what this demonstrates is the fact that empirically, in the first 2 years, and the program really hasn't gotten going yet because they didn't even finalize the regulations until the end of 2019. They were able to demonstrate that average property values in the opportunity zone census tracts that were selected at opportunity zones, they outpaced either eligible tracts that didn't get selected or non-opportunity zone tracts in terms of average weighted value of property sales. The data will show that that trend has continued through 2021. So again, Carlton went through this. The opportunity zone space is the land of acronyms. So we apologize in advance, but we didn't give them these acronyms. The IRS did. But here's a few of them. We're gonna talk about them. So this slide you may want to keep as a handy dandy as you sort of get more familiar with the space. But these are the acronyms that Carlton went through as well. Next slide. Okay. So again, in order to take advantage of this program and to accomplish the mission, which is to drive private capital on an unlimited basis into communities that qualify as opportunity zones, we have to follow the steps set forth in the tax law and the regulations. And essentially, this is what happens. We start with taxpayers who have capital gains that are realized from an unrelated transaction. Unrelated parties. I mean, husband and wife can't sell to each other and create a capital gain. It has to be to an unrelated party. With that capital gain, Carlton referred to this in his initial remarks, that capital gain is invested into an entity called a qualified opportunity fund. Why is that the case? Well, that's the way they set it up, and there are reasons for it, but every one of these has to go this way. We'll get into a little bit more detail in the future slides. And then that opportunity fund makes qualifying investments into what's called qualifying opportunity zone property. Everything is set up this way. And we do it this way because that's what the regs tell us to do to accomplish I call it the trifecta of tax benefits. One, the invested capital gain gets deferred, not forever, but until the end of the tax year in 2026, at which point in time, when the tax return is filed by the taxpayer who deferred the gain in 2027 for the 2026 tax year, that capital gain will have to be paid at that time. So it's not a forever deferral on the original gain that's deferred. It's until the end of 2026. But wait, there's more. There's a partial forgiveness of that gain. There's a 10% discount on that gain when paid in the 2026 tax year, as long as the investment was held for a minimum of 5 years inclusive of the entire year of 2026. So you get a 10% discount on the gain that you're paying for the 2026 tax year. But wait, there's more. And with respect to the tech community, there's a lot more. The third of the trifecta is really, really relevant to qualified opportunity zone businesses, and particularly high growth businesses like tech businesses. To the extent that an eligible investment is held for a total of at least 10 years, and it appreciates beyond the amount that was originally invested on which tax was paid in 2026, then that excess gain will be completely tax-free, again, if it was held for 10 years. So we'll have an example that we'll go through this in the coming slides to really illustrate how this really works, particularly in the tech industry. Next slide, Chris. Okay, again, really, really important to understand that all qualifying capital gain investments have to be structured in the same general way. We have the qualifying capital gain from the taxpayer that on a timely basis, as Carlton pointed out, within 180 days of being realized, is invested in equity in a qualified opportunity fund, not debt equity. Second, The qualified opportunity fund then must make a timely investment, again, within 180 days of when the qualified opportunity fund receives that investment. The qualified opportunity fund must deploy that investment into eligible investments. And those can be either qualified opportunity zone businesses or qualified opportunity zone business property. And that business property is typically real estate, equipment, or other tangible property. Now, a qualified opportunity fund, let me just back just a second, Chris. Qualified opportunity fund can have 10% of its assets in non-qualified property and not lose its status as a qualified opportunity fund. It may need to hold cash or marketable securities for working capital, or even a non-qualifying businesses that is not a qualified opportunity zone business could be in that 10% hold. So let's go through an example, and hopefully this will make some of this a little bit clearer and touch the tech industry, your space, a little bit more. So let's go through the assumption here. And in this case, this example was sort of dictated towards the investor. The investor invests $1 million in 2015 into Tech Inc. stock. The investor then sells Tech Inc. stock in 2021 for $5 million. That creates a $4 million capital gain. It actually realizes a $4 million capital gain. So let's assume that the investor with that $4 million capital gain does not want to pay tax on it in 2021, wants to defer it. So he or she invests the $4 million gain in a qualified opportunity fund, because all of these qualified investments must go through a fund. Okay, this will leave the taxpayer with $1 million, which is the basis in the original Tech Inc. stock that he or she doesn't have to invest in the qualified opportunity fund, because it's already tax-free. You don't pay tax on that basis. You keep it outside of the fund, you do with it what you will, but it is tax-free. All right, continuing on then. So the taxpayer holds the QOF investment through tax year 2026. Tax on the invested capital gain is deferred, as we said, until the end of the 2026 tax year. And again, there's a 10% discount if the investor holds the qualifying investment for at least 5 years inclusive of the 2026 tax year, which means, and this is significant for this year, in order to get that 10% discount, QOFs need to be funded by 12/31/2021 in order to get that 10% discount on the taxes paid in 2026 tax year. All right, continuing on. So the taxpayer holds his or her qualified opportunity fund investment for 10 plus years, and it appreciates to $12 million. Remember, we originally invested $4 million in the QOF, 10 plus year hold, now it's worth $12 million. And let's say we sell it in year 2031. The additional capital gain of $8 million, because remember, $4 million capital gain was paid in the 2026 tax year. The excess capital gain is completely tax-free after a 10 plus year hold. So again, when I saw the benefit of the 1C slide, I said, oh my gosh, this is an incredible benefit for the tech industry. However, those of us close to the tech industry and you folks creating new tech businesses understand that in our industry, the tech industry, 10 years is a long time. It's an eternity. In fact, it's 3 eternities in the tech space. That most successful tech businesses are likely mature in 2 to 3 years, and an exit is usually contemplated within 3 to 5 years. So the regs do contemplate and provide for this, I think, in a very favorable way, in actually 2 ways. One is, if the QOF had a mature tech business and wanted to exit it, it could sell the business interest, the qualified opportunity zone business or property, and reinvest the proceeds of that. This is the QOF now reinvesting it within 12 months. Then there's no harm, no foul. The investment, the investor's investment in the QOF continues as a qualified investment, and the holding period towards the 10 plus years continues to tack. So there's no penalty there as long as the QOF manager invests it in another qualifying business or qualifying property within 12 months. Now, there's also a case of a QOF investor that wants to say, you know what, I want to get out of this QOF. I don't like it, but I want to continue my qualifying investment by investing in another QOF. That's the second circle here. And that is possible to do, but the investor must take the proceeds of the sale from the first QOF interest and invest it in another QOF within 180 days in order to continue that as a qualifying investment. But it's a new qualifying investment, so the holding period starts over, it doesn't tack. But those are two ways to sort of, that I think are particularly geared towards high growth businesses that could be opportunity zone businesses like tech businesses.
Patrick, can I add something real quick?
Yeah.
That I think is important to talk about is that, and I hear this all the time, right? It's that an opportunity zone does not make a bad deal a good deal, right? So it's important to know that like a lot of these investments are not just opportunity zone investments, right? They're coupled up with others. I just wanted to kind of like say that this isn't the end all be all, right? This is like the cherry on top of the frosting on top of the cupcake.
Yeah,
right?
yeah. Excellent point, Chris. And anybody in the investment world will say, well, just because you get a tax incentive doesn't make a bad deal good. It still has to be a good deal. In fact, the data shows in our OZ Works community, the fund managers, the professional qualified opportunity fund managers will tell you, look, the deal has to pass due diligence. The deal has to make economic sense. Carlton, you've looked at a lot of deals and you say the same thing, and you remind us constantly, this deal has to be a good deal. And as Chris said, the incentive of the opportunity zone potential tax savings becomes the the cherry on the sundae, and it could drive some capital in that would might not otherwise be found or create a new source of capital. But Chris, completely right. None of the fundamentals of venture capital investing or real estate investing can be thrown out the window just because we happen to have a qualifying investment. All right, so again, through the regulations, they say, well, yeah, qualified opportunity zone businesses. Obviously, those businesses have to have a nexus, a definable nexus to the opportunity, to one or more opportunity zones, and that gets kind of into opportunity zones 201, where there's, what is it, how does a business become qualify as a qualified opportunity zone business? It's got to have that nexus, but the regs also say, well, there are some businesses that I don't care how close of a nexus you have to an opportunity zone, we ain't going to include you. And of course, we're not going to include things like country clubs, golf courses, massage parlors, hot tub facilities, and suntan facilities. And I'm thinking, we're talking to a group in Southern California. Let them have a suntan facility. But no racetracks and no packaged liquor stores where you take your liquor off premises to consume. And that list of businesses is like, that is the list that's in the regulations. It actually comes from from a similar list for new market tax credits that they just sort of plugged and played into the opportunity zone space. But it also sort of begs a bunch of questions. Like, well, what if a business isn't named as a sin business, like cannabis or legal marijuana in California? It's illegal under federal law, but it's legal in California as it is in Michigan. And I think medicinally it's legal in Missouri, Carlton. Is that a sin business, or it's not on the list? Can that be an opportunity zone business? And again, that's where we have groups like the OZ Works platform, because the lawyers, the accountants, the business people, the investors kind of debate these things back and forth and say, look, the IRS, do they really intend that things that are illegal under federal law be able to take advantage of this tax benefit? I mean, they also didn't list, a kidnapping ring in the sin businesses. But so I think the lawyers and the accountants and the platform are saying, look, no, if it's illegal under federal law, it's probably not it's going to get blown up on audit. as long as it's illegal under federal law. But there are some practitioners that would disagree. But there are some other, more in the weeds businesses. The sin businesses only apply to qualified opportunity zone businesses. They don't apply to qualified opportunity funds, which the fund could carry on a business. Could it carry on a sin business? That's a tougher question. We don't, quite frankly, have the guidance from the IRS on that. And what if it's just a landlord? What if the QOF or the QOZB is just a landlord, a real estate holding company that leases property to a sin business? The opportunity zone business is the real estate business, not the tenant's business. Would that then qualify? And we see a lot of this in the cannabis space where real estate investors will come in, form a QOZB, capitalize that, and be the landlord, and then lease to a licensed cannabis grower or processor. And I've seen those deals. And so it's interesting questions arise, but I digress. Next slide. So this is a good slide to just kind of keep in mind a few scenarios which are sort of ripe for opportunity zone businesses and investments. Commercial real estate development and renovation in opportunity zones, opening new businesses in opportunity zones, expansion of an existing business into opportunity zones, from outside opportunity zones, expand into opportunity zones, or large expansions of businesses that are already in opportunity zones. As long as there's a significant expansion, they could make that already existing business into a qualifying opportunity zone business. So, and that happens through a bunch of regs, which are, again, beyond the scope of 101. As I mentioned before, and Carlton did as well, the idea here is opportunity zone programs are not the whole game. There's a lot of other incentives and programs that need to be considered as you're putting your capital stack together. And again, as Chris mentioned, none of these make a bad deal good. Low-income housing tax credit, significantly go back just a second, Chris. I wanted to point one thing out to the group. Section 1202 says 1202. What I mean there, and this is very significant for tech businesses, that's the issuance of qualified small business stock by a C corporation to its shareholders, even its founders. And if properly done, and this is particularly relevant for a tech business, with a 5-year hold, all of the capital gain on that stock would be tax-free under 1202, 5-year hold. So again, that kind of more lines up to a life cycle of a tech business. But we find a lot of tech businesses that are seeking to attract capital. They want that deferral in, but they would like to hold for less than 10 years. So they qualify for both 1202 and opportunity zone. So again, it's sort of a mix and match hodgepodge. As Carlton mentioned, we do a lot of speaking to real estate groups. So they are always saying, we already have this benefit. It's called 1031. And we're like, no, look at this slide. There's a lot of differences here. And I'll just leave it to you to consider that slide when you have an opportunity to. And a lot of information available. This is just a taste of what information and referral sources that OZWorks platform brings us. Chris?
Yeah, thanks, Patrick. I mean, this is like, it's going from 101 into slipping into 201, and I love it because it's like, it's nice for me to even get a refresher every once in a while. I do want to just say, John, I know we don't have a whole lot of time left. I was going to give a little sort of intro to OZWorks Group quickly, unless there's like questions.
Yeah, we have some time for that, but let's take a question from the audience. Charles actually asked a couple of great questions, not just one. But yeah, Chris, we'll have some time to we can talk more about OZWorks, and this is recorded anyway, so it'll be
Absolutely.
available, in posterity. So Charles, so for Charles' question, Charles asked, his first question: are the opportunity zone funds equivalent to a mutual fund or exchange traded fund? We saw there's an opportunity list. One of my questions too, to kind of piggyback on top of Charles' questions, was, is there a finite list of opportunity zones, or is that like this is the list, or are new opportunity zones being created, going forward?
I'll answer the about the opportunity zone, the list, and et cetera, and maybe Patrick or Chris can answer the other question. The opportunity zones that exist nowadays are the only opportunity zones that will be available now and in the future. According to the federal guidelines, there will be no new opportunity zones created after the additional legislation. And that's
They
why
actually,
I said,
yeah, agreed 100%, Carlton. They actually considered recently with the 2020 census whether we should refresh the opportunity zones to be more relevant, because the original ones were selected from 2010 census data. And what we find is some of these areas that did meet the economic distress sort of levels to qualify to be considered really developed on their own. There's areas that, for example, San Jose, that you wouldn't think would be opportunity zones, but they are. So there was an effort to at least consider refreshing them, and it was rejected, at least at this point in time. So on the first question for is that Charles's question?
Charles, yeah, Charles, yes.
Yeah, Dr. Charles. Mm-hmm.
Yeah, and Jonathan, yours as well. Opportunity zone funds, they can look like a mutual fund or a venture capital fund. They can and there are some that are raising $300 million, $500 million to do various real estate development projects professionally managed by an established real estate development and management firm. And then the investors would participate with equity investments, and they'd be inactive investors, and they would just flow with professionally managed funds. But it's flexible enough that, and I do a lot of this for investors that are what I call self-directed qualified opportunity funds, where the taxpayer sets up his or her own, sometimes it's a family qualified opportunity funds, which they manage. And then they also select which businesses or properties they invest in, and those businesses or properties are again managed and owned by the fund and by other family members. So it can be a family company, or it can be a huge syndicated professionally managed fund. The main thing is if it's a small one, it has to be, if it's a corporation, it can be a one-person corporation, as long as it's a C corporation. If it's a pass-through, it has to be two members if it's an LLC or a partnership.
And that's helpful. And yeah, thank you, gentlemen, for that. And then, Chris, before we get into Osworks platform, the second question, and then we'll pick up more questions as we learn more about Osworks. As far as rating agencies, so if I go to Opportunity Database, the database link that was provided, and I see a whole list of opportunity zones, we have things like, SEC oversight, ratings agencies. How do I distinguish between, a junk bond opportunity zone versus like a AAA, opportunity zone? How do you even know what's good and what's not?
Real quick, John, I forgot. There's only one publicly traded qualified opportunity fund that exists right now. Only one. Actually, they're members of the or some of the involvements are members of OZ Works, but they behave like any other investment fund, and they have to be SEC compliant. If they are raising money from institutional investors, the institutional investors may require that they be rated, but there's no requirement in the IRS regulation that they be rated at all. But they do have to comply with SEC mandates and all of the above there. But typically they are private, like investment funds, hedge funds, or as I said, investment funds, and only one that's public at this point in time.
Thank you. All right, Chris, you tell us more about Osworks, and then as people have time, if we want to get folks questions asked and answered too.
Yeah.
But yeah, good stuff. So other folks think about your questions too and get those queued up.
Yeah, absolutely. Chime in with other questions. And I'm not going to take more than the 1 minute that we have left. So as I mentioned, early on in Osworks Group, which is this private network that gets you connected to all kinds of resources like Patrick and Carlton, and the list goes on. we launched a diversity, equity, and inclusion scholarship that we talked about in the beginning of this call, and I want to make it available to this group. The whole goal here was to provide an education for people who actually represent opportunity zone communities, and then to give them access to the 201 type of education, right? That becomes more advanced, but not that you have to learn it all. It's there if you want it, if you'd like to learn it, but that there are also people that we can connect you with. So Osworks Group operates sort of as this concierge service where we get to know everyone and we make these connections happen based on need. So I'm going to drop a link in the chat here. This is a link to the landing page for our DE&I scholarship initiative. So it's for 6 months of free access. There's a registration. The page will let you read a little bit about why we started this, about who's behind it, and what we stand for, why it's important to us as an entity. And then there's a link in there to join first an info session. So we do have an application form that gets filled out, but what we first like to do is just introduce you to the people who are actually sponsoring this. So you get to meet them and some other folks who are behind the scenes, and then talk through what the application actually looks like. So it's not as complex, really, because everyone's here. They've pretty much seen the 101. There's a video and just some really brief questions, but this is something that I really wanted to be able to present to your group, John, and make available certainly for everybody here.
Yeah, thank you very much, Chris. Very generous, especially for those who, are going to be diving more into their learning for opportunity zones. So, yeah, thank you for that.
Yeah, absolutely. I mean, this can be like really in-depth stuff, right? So we find that people usually browse around. If this is your first like dabble into the opportunity zone landscape, it's like, whoa, this is a lot, but it's incredible. And we want more people to know about it and understand it. Like the whole thing here is demystification, right? Like it's not that complex. It's education first. Like first thing is educate about OZs. Second thing is educate about finance, right? And capital. And the third is like get access to that capital. And so we do all three of those things in here. And yeah, guys, is anything that you want to add or?
Well, once again, I love being a part of the DEI community and the Oz group and the platform. And one of the things I like to mention is that a key component or key activity of the Osworks group is that we have pitch day, where you can actually come and pitch your different products and your projects and your businesses into our network, and that can prove to be a valuable resource for you. But if you become a subscriber, you won't go wrong, and you'll add value to the activities that you are involved with. So and that pitch day is a really wonderful activity, and it really I enjoy being part of that.
Yeah, we've got it. Thank you, Carlton. I mean, we've got a couple other things for tech companies like the ones that are here participating. Like we're actually starting a pitch track, and so we've got some really cool tools that we're launching even here coming up in the next couple of weeks. So I also put the link just to our main landing page. If people want to join in the scholarship conversation, like that's totally available here. If you're just like, I'd rather dive in, you can find a pathway right in sooner than later if you'd like. But I just want to make as many options available for people that are here. And I appreciate you, John, opening this conversation up to your community, and thanks for everybody for joining too. Yeah, Patrick.
Yeah, definitely. And I just had one other question too. And what I'll do, for folks present, who participated today, and for those who couldn't make it for whatever reason, is I'll send out a communication, to our entire group so they can check out some things offline. But how I got introduced to Opportunity Zones, I heard it kind of in passing in some podcasts. I was aware. I just didn't really know what it was. I think I even heard a rap song. Somebody mentioned Opportunity Zone, and I was like, you know what? I think I need to pay attention now.
I gotta find that one.
I know. I was like, wait a minute.
Now, John, I'm hopeful that was produced in a studio that was a qualified opportunity zone.
Yeah, for sure.
That would be full circle. And I know Kevin, who introduced me to Chris, mentioned HBCU opportunity zones. I guess there's some HBCU areas where, they're using the opportunity zone platform to promote investment in those. So that kind of piqued my interest as well. So I still have a lot to learn too. And, thank you for, kind of getting us going with this whole conversation.
Yeah, for sure.
Chris, I'd just like to add real quick that I believe so heavily that really the best sort of space to benefit from the opportunity zone benefit incentives is the tech industry and the applied tech industry. So I would like, no matter what, obviously, I think I speak for all of us. If any of your membership have any questions about anything opportunity zone, feel free to reach out to us. Our emails are in the deck, and we're happy to connect. But also, let's keep the dialogue going between our two groups. I think there's so much synergy here. I'd like to see that.
Agreed. John, let's definitely have a follow-up. I mean, feel free to post all the links that we shared. I don't know, Carlton and Patrick, do you want to put maybe your email address in the chat?
It's in the deck.
It's in the deck.
It's in the deck.
We'll definitely share that. So John,
we can put it in the chat as well, I suppose.
Totally up to you. Yeah,
the deck will be fine. We'll be sure to get that out. But yeah, this was a great conversation. I like to thank our new friends. Carlton, Patrick, Chris. Thank you so much. And thank you for all of you who took time. Regardless of what time zone you're in. To listen to and learn get this valuable information, and hopefully you're able to take it to the next level. And if you have success stories, do share. That's ultimately why we do these things, is we want folks to take action on it. So, looking forward to seeing some good outcomes from those who are participating. Appreciate it.
Beautiful.
Hey, it's been a wonderful evening.
All right.
Thanks to all.
Yeah, thank you. I'm going to go ahead and sign off. Thanks, everybody. Have a great rest of your night. Take care.
Take care, everyone. Thank you, guys.
Good night, everyone.